Understanding Portfolio Investment, a comprehensive guide. Portfolio investment plays a crucial role in the financial landscape by helping individuals and institutions achieve specific financial goals through a diversified array of assets. This guide delves into the essential aspects of portfolio investment, with a focus on building a robust and tailored investment strategy that aligns with individual risk tolerance, financial goals, and market dynamics. What is portfolio investment? Portfolio investment involves acquiring and managing a collection of financial assets, such as stocks, bonds, real estate, and commodities, with the goal of balancing risk and maximizing returns over time. This practice transcends mere trading, emphasizing strategic asset allocation and diversification to mitigate inherent risks associated with different types of investments. Key elements of portfolio investment. 1. Asset allocation. Asset allocation refers to the distribution of an investor's funds across various asset classes. This decision should hinge on individual financial goals, risk tolerance, and investment timelines. Investors may adopt varying styles, ranging from conservative, leaning towards bonds and cash, to aggressive, focusing on high-growth equities. 2. Diversification. Diversification is the cornerstone of effective portfolio management. By spreading investments across various sectors, asset types, and geographic regions, investors can minimize the impact of a poorly performing asset on the overall portfolio. A well-diversified portfolio may include equities, bonds, real estate, and even alternative investments like cryptocurrencies or collectibles. 3. Managing risk. An essential aspect of portfolio management is risk assessment and mitigation. Investors should balance their portfolios according to their risk appetite and regularly rebalance to maintain desired asset allocations. Tools such as stop-loss orders and option strategies can help protect against significant losses. The importance of portfolio investment. Portfolio investment has gained increasing significance, particularly in today's financial landscape where traditional pension plans have shifted towards individual retirement accounts, like 401(k)s. Understanding how to construct and manage a portfolio is no longer exclusive to finance professionals but is crucial for anyone striving for financial security and a stable retirement. Asset classes in portfolio investment. Understanding the different asset classes is fundamental in constructing a comprehensive investment strategy. The primary asset classes include 1. Equities, stocks. Equities represent ownership in companies and can be classified into common stock, offers ownership and voting rights, typically more volatile but with higher long-term returns. Preferred stock, hybrid securities that pay fixed dividends and have priority over common stockholders during liquidation. 2. Fixed income securities, bonds. Bonds are investments that provide regular interest payments and return the principal at maturity. Types of bonds include government bonds, generally considered lower risk, suitable for conservative investors. Corporate bonds, higher yield but with increased risk compared to government bonds. 3. Cash and cash equivalents. This category includes cash acts, money market funds, short-term treasury bills. These assets offer liquidity and stability, though they may not keep pace with inflation. 4. Alternative investments. This expansive category encompasses assets such as real estate, can be physical properties or real estate investment trusts, REITs. Commodities, raw materials like gold, oil, or agricultural products. Cryptocurrencies, digital assets that have gained popularity but come with high volatility. Collectibles and art, tangible assets that may appreciate over time, although with lower liquidity. Building your portfolio. When constructing a portfolio, investors should follow a structured approach. 1. Understand your goals and risk tolerance. Assess your financial objectives and how much risk you're willing to undertake. 2. Choose asset allocation strategies. Decide on which mix of equities, bonds, cash, and alternative investments aligns with your risk profile. 3. Diversify across assets. Ensure your portfolio contains a variety of investments to minimize potential losses associated with any single asset class. 4. Regularly review and rebalance. Set a schedule to evaluate your portfolio's performance and rebalance as necessary to maintain your preferred asset allocation. 5. Consider professional guidance. Engaging with a certified financial planner can provide personalized insights and strategies tailored to your individual financial circumstances. Conclusion. Portfolio investment is a profound technique that can significantly influence an individual's financial health, particularly as one prepares for retirement or other long-term financial goals. The journey involves not only selecting assets but ensuring those choices align with personal financial objectives, risk tolerance, and market conditions. By embracing the principles of asset allocation, diversification, and risk management, investors can construct a portfolio that withstands market fluctuations, potentially leading to greater financial stability and success. As you embark on this journey, remember that knowledge is power, and understanding the nuances of portfolio investment is critical in navigating the ever-evolving financial landscape.